We're here over, we've been taxed enough already.
A fear of seeing those opportunities erode with further government intrusion, further regulation, higher taxation. It's what really got me wanting to make a difference.
I work at a warehouse where I got, health insurance for them, and they pay the biggest part of it, right? What's this stopping a company like that from dumping you off and just paying the penalty? The penalty would be less than what they pay for the health insurance.
Not one thing, and you find that's going to happen. In my instance, I have to pay for my employees. I pay for all of it. And my cost has jumped again this year, almost $9,000. I mean, that's my little operation. It costs, and if that stays in place, it'll cost me about $87,000 to $90,000 a month. And the only place you can cut it is you have to reduce the level of coverage that is available. You will find already, as your policies renew, you are going to see huge increases. And the reason for that, insurance companies see what's coming down the road. It's not about health insurance. It really isn't. It's about the government trying to control you. The problem of what you have was never tackled, and that is tort reform. It was never tackled.
Banks were bailed out. We saw that the auto industry was bailed out. But something that got even less attention on the news media and on the major stations around was that state governments were getting bailed out. North Carolina got bailed out. The federal stimulus package, some of you may already know this, but if you don't, you still need to know. The federal stimulus package that passed last year spent over $800 billion in bailouts. North Carolina last year, in our last legislative session, we increased taxes by $1 billion. That's our sales tax, our state tax. I mean, that's unbelievable. It's $1 billion worth of tax increases. What else is going on in the state? Well, the unemployment insurance fund is currently over $2.5 billion in debt to the federal government, and it's estimated to be at $3.5 billion by the end of 2010. The federal government's going to start charging us, that's you and me, taxpayers, just like us, 4.5% interest. To do what? To pay off the loan. Because they have to pay off the loan because they owe the government money. It's $150 million in interest. Are we going to continue to let the federal government bail us out just to turn around and increase our taxes, make us pay more money, and make us pay off their loans?
Start taxing in 2010. The healthcare doesn't start till 2014 in order to sell this thing and pay for it the first decade. Okay, then what happens in 2020? Do we tax from 2020 to 2029 and shut off paying until 2025 to keep the next decade in balance? But right now, our spending is at 28.5% of our GDP, of our economy, which is about $14 trillion, is the size of our economy. And taxes are only right now at about 15%, which means the difference has to be borrowed and accumulated in national debt. So we have these deficits now of $1.7 trillion. And if you think they're going away with national health care, then you believe in the tooth fairy. As long as that gap remains, and it will, history shows us this, that federal tax revenue of 19.2% isn't going anywhere near where government spending is going to be, and that's why you're going to see the VAT tax. So what did we do during the Great Depression? We had a big budget deficit. What did Herbert Hoover do? To balance the budget, he raised taxes in 1931 from 25% up to 63. Roosevelt put them at 79, 88, and then finally up to 94% during World War II. Now this is the worst economy we've had since the Great Depression. It almost matches the recession we had in 81, 82, if you can reflect back on that, not so fondly. Do you raise taxes in an economic downturn? Do you burden business with more regulations and layers of entitlements to make the economy recover?
No.
Economics 101 says that's nonsense. Once your debt to GDP ratio hits 90%, throughout history, governments whose debt to GDP ratios have crossed the 90% threshold have their long-run rates of economic growth fall by a full percentage point. Tax revenues flow as people's income and standard of living go up. What would happen to our ability to fund all these promised liabilities over the next half a century if our economy slowed down by a full percentage point of economic growth? We couldn't pay for it. Can't pay for it now. We couldn't possibly pay for it if our economy slowed down. But that's what we're looking at. People say, don't worry so much, because we'll do like we did after the Second World War. We borrowed a bunch of money during the Second World War, but then stopped spending so much because we won the war. The economy grew faster than our deficits, so the debt to GDP ratio fell very rapidly, and the debt wasn't a problem. And that was right. Because in 1945, the defense budget as a total share of the federal budget was enormous. War's over, you can cut that out. Stop it, it's over with. Now I hear people like Paul Krugman say, well, we're going to do the same thing. Once we get this debt stabilized, the economy will grow, and the debt to GDP ratio, our economy will grow so fast that it'll shrink over time. Wrong. That's wrong. Why? Because now such a big part of our budget is mandatory entitlement spending. And this graph was even made before Obamacare was passed. Now Washington dictates to North Carolina and Mississippi what your levels of Medicaid spending are. And they want it just like the people in New York do. What's that going to do to your tax burden in the spending in North Carolina? You only get 65% compensation from the federal government. You got to pay the other 35%. The best way to think about what we got going on is over a number of generations. Don't just look at the debt today or deficits today. Think about what's been promised in spending from now until 2060, and then compute the implied tax collections that we can expect between now and 2060. Now, I know that's going on a long way. I know that prediction's a difficult thing, especially when it has to do with the future. I understand all that. But this graph right here shows us between now and 2060 the explicit debt that we have and how much debt is going to be implied because of the difference between what we promised and what we're going to take in taxes under current legislation right now. So the way to interpret this graph is that in 2060, if we just take current legislation with tax collections and current promised benefits, our debt to GDP ratio will be over 400%. What this suggests to you, or should, is that without massive decreases in spending or massive increases in taxes, this is the type of debt to GDP ratio we'd be looking at in 2060, and that's untenable and unsustainable.